Stan Gregor, do you know
Roger.
do you know how long I've been asking to do a podcast with you? It's been a year and a half. I'm like, Stan, we got to talk to you. Got to get you online. So finally got you.
Yeah, looking forward to it. Thanks, Roger. It's
I,
been a
re-
while.
I really appreciate the opportunity to have you on and tell your story because your story, in my personal opinion, is one of the most exciting stories on Wall Street.
Thanks.
It's not only your background, um, the advisors that you're bringing on, the advisors who love the firm. And rarely do we ever see advisors love where they work. And so if you could talk a little bit about your background, what has come to this point in your career, your background, but also what drives Summit, and really appreciate the opportunity.
Well, great to see you, and I hope you're having a great summer. And thank you for the invite, and I'm looking forward to today. So let's have some fun.
Done.
Uh, my background, I mean, I've been in this space for almost 40 years, as you probably know, and like many of your listeners, I was sitting in the chair as an advisor, many years ago, running my own book of business, generating millions of dollars of fees and whatnot. And like all of us, we've seen firms that have built great platforms. And as advisors, we're probably the best critics of what we need to grow our business. And I was with a major firm at that time. I was with Citi for almost a decade. And I personally got frustrated because what I needed to grow my practice and service my clients was not really being met. So I made the cardinal sin of moving into management. And, upon moving into management, we went through a major merger, probably the largest merger at that time between Citi, Travelers, Smith Barney. I was fortunate enough to be tapped on the shoulder to run a senior position, and also have influence on what we can do as a firm to roll out different services. And that began a lot of the industry change, I thought, with that Sandy Weil merger. And from there, moved on to, Fleet Boston, Financial, B of A, and a number of the other big bulge bracket banks that we all know of, and retired from Wells in 2010.
Hmm.
Like over those years, I learned quickly some of the frustrations that I had as an advisor, and many of the advisors that I was partners with. And I also learned the difficulty of rolling out what I needed as an advisor down to that level from some of the different constituents and divisions of these companies. A lot of it was political, but a lot of it was just self-dealing that I just couldn't get my arms around. And we see that all the time, right? It's conflicts that take place. And when I left the big banks in 2010, one of my promises that I made to myself was if I ever have a chance to truly control this, I want to do it the way that I feel should be done for advisors. And it took some time. It took a number of years to kind of find that right mix and model. We I met with a number of my friends and partners, and obviously my partners over at Merchant that have a tremendous experience. And Summit kind of came along as a fluke in introduction. And we looked into Summit. At the time, it was what, 35 years old, probably had about $3 billion of assets. And what intrigued us was kind of what you said before. There was just no attrition with the teams that joined Summit. The big firms I worked at, oh my God, we bring in 5,000 advisors, lose 5,000 advisors. It's just that, hamster in the wheel effect.
Hmm.
And here, that was not the case. And so that was my first item that piqued my interest of how's this possible? Why are you guys not leaving? And the deeper dive I took into the firm, I realized it was all the stuff I wish I had when I was at the big banks, um, from a service standpoint. So having in-house professionals that truly can make me look smart, in-house professionals that can help me win business, that have my back with knowledge, information, expertise. And the deeper we went into kind of analyzing it, we realized this is the model for the future, right? And while Summit was around for 35 plus years, They did it in a way that I thought was smart for the existing partners, but their goal was never to take it national. Their goal was never to make this a massive recruiting engine or model. Their goal was they were all advisors, and they wanted to have the best people on the ground to help them look smart, win business, and grow business. So we felt if we were to make an investment in this company with hopefully our expertise and our backgrounds and our capital and our investments and knowledge, we were able to build something that truly was, I would say, the wealth management firm for the future, right? And that's what we did. And you're going to probably, find it's hard to believe as a person that does investment banking and recruiting, but I shut down recruiting for 3.5 years.
Wow.
Okay, for 3.5 years, we spent time into making sure we had the right people, the right processes, the right technology. Are we with the right custodians? Is this the right investment platform? So it was a 3+ year endeavor of just let's rebuild for the best. And we built what is today a multifamily office service model that has what I consider some of the smartest technology the industry has to offer. And very little of that technology is Summit proprietary. What we did is we made sure we had access to some of the best technology, but that it synchronizes with everything we do. So the analogy I would give you is, think of your iPhone and you download a new app and somehow everything works from contacts or whatnot. That is how our technology works. So using using names like Addepar, eMoney, hidden levers, the DocuSigns, the typical basic functionalities where it's a single ecosystem, single sign-on, all encrypted, all cyber protected. It was a game changer for us as a firm with efficiency and scale. And I look at 2020, we were probably about a $3 billion firm at that time, three, maybe three and a half, approaching today close to 25 billion. That's both on our chassis and minority stakes that we own elsewhere. And of that growth, I would say more than half of it was organic,
Hmm.
right? We
Wow.
had a wild year last year on new firms being partners with Summit. I think we probably added close to 30 new teams and 30 new firms. But the growth that came organically is probably half that revenue that I mentioned, or AUM, came from organic growth. So the model works. You referenced that people love it. Yeah, advisors love something when it works and it benefits them. And we've seen so many teams come in that were successful and realizing the tools and resources they now have at Summit, they've been successful at an X factor, right? It's been significantly higher. So I'm proud of the team, and we're not stopping on the innovation trail. We want to continue to find ways to help our teams, expand their businesses and practices and grow.
You hit on a point about why the old big bank models, were they used to be working for the advisor to help them grow, to support them. And over the years, unfortunately, between legal and compliance and how these firms got so big and the costs associated with it, much more focused on their bottom line, right? And taking away from the advisor. And that's not the model that you obviously wanted to create at Summit. And it's not about making the most money for the firm. It's building the most enterprise value for the firm. And the cost associated with doing business at Summit is probably one of the lowest in the industry, right? It's not about making profits. It's about
Mhm.
growing the enterprise. And that's why, in my opinion, advisors really love the firm, not only to help them grow in a great platform, but also have ownership, have independence, but ownership in Summit. If you can talk about that, that'd be great.
Yeah, yeah. So I've run those major programs, and if I'm being honest with myself, a lot of the ways we designed those models was managing to the lowest common denominator, right? How do you do it in scale? So in every one of those firms that I oversaw, your probably your smartest, most sophisticated advisors were the most frustrated because they wanted to do more and couldn't do more, right? They were restraints. But the masses seem to do okay and kind of stayed there. So that's a model that's been around for a long time. Uh, in our structure, we wanted to create a model that gave the advisors a chance to truly go up market and go broader. So the services, the people, the chassis, we cover that already. But Roger, a big piece of what I think is different here is the structure. Okay, this is a true partnership.
Hmm.
And unlike, when I think about my roles at the B of A's, the Wells, the Wachovias, and cities and all of that, most of the advisors were in that 30 to 50% payout range. And a lot of, yes, they had an office, but that became less important in an advisor's eyes when you go upscale in revenue, you're paying a lot for an office if you're taking or giving away 50% of your income. But in our model, we were very clear in what we wanted to do. There were three things we looked at. Number one, we wanted to structure the firm as a true partnership, right? And partnership, it really is what I'm saying. It is a partnership. So we all, as partners, have the same equity, right? I don't have a different equity class than the next guy who's an advisor or what, pick anybody who's a shareholder. We're all involved in the same pool, and we structured as a partnership. Two, full transparency. I never had full transparency at those big firms. I had no clue where the heck the allocations were coming from or why, or there was always something that was changing, and you had to kind of let it go and don't get aggravated, but you never had transparency of that. So, partnership one, transparency two. Number three was we built the model as if we were going into business with our kids, right? So when you put that level of standard on what does that model look like? Well, then you start thinking, how do you charge your kids for certain services? And what would you charge them for? So we specifically said, when it comes to our partnership structure, we need enough profit to pay our people and, kind of cost of living adjustments, but to make a 30, 40, 50% margin, would you do that to your children? Like, no, right? So that's not our model. So our model is the mothership provides all the services, the teams, the resources, the real estate, the technology, the people. And we try to cover our costs with that and a little bit of a margin to make sure you're sound and you can continue to grow. But where we invest is in the partnership, right? So we make an investment within our teams, just like you would do with your children, and say, son or daughter, let dad take a minority stake in your business. Take this money, do with it as you wish. Use dad's resources, my technology, my people, my knowledge, and go grow your business. And if we can help you grow your business, the investment that we made is going to be worth a hell of a lot more than what a traditional model is in nickels and dimes people on so many cuts, along the way on expenses. So yes, our infrastructure is extremely scaled, right? There are hundreds of millions of dollars across the different channels that are being generated in fees. And we built a model where, if we call it 10 basis points or so, we can deliver a lot of these services, if not most of them, which is a fraction of a cost of, if you or I were going out on our own to go, try to replicate what we have at Summit. So it's
Yeah,
a completely different model.
can't. Yeah. So cost of doing business is low. Advisors have a say in, what they like, what they don't like, software solutions, problems that they're having. Um, and let's talk a little bit about the investment that you make in them besides the
Mhm.
infrastructure. Let's talk about the investment you make in them in their equity and them as a partner. A little bit about the valuations, because advisors hear these crazy valuations and what's realistic. Advisors all know who's listening to this call, the big banks will offer them 400% plus or minus deal, but there's a front end, there's a back end, there's a lengthy contract, there's an EFL, and there's ordinary income taxes. Okay. So your model is making an equity investment in them
Hmm.
at a good solid multiple, depending on the quality of the team you bring in. You're very discerning, Stan, on who you bring in. I brought you a lot of candidates, and fortunately, many of them meet your criteria, but unfortunately, some have not, right? You're very, very discerning, which is really great, which is testimony to your model. But tell us a little bit about um, how you make that investment and why that investment, not only how it grows, but how it can yield a substantially larger return because of the relationship with merchant.
Yeah. Look, I worked in a wirehouse. I had a book of business, and I was one of those recipients of those, those packages that the promissory notes and 7, 10 year notes and all that. So I'm familiar with that. I don't know how many deals I've signed off in my career, but it's probably, in the thousands. Um, that is a great mechanism if you want to trap somebody to stay within a firm for a long time because they give you a check, and it's hard to pay it back after you spend some of it. So it George Ball was the first guy that rolled out that structure back in the early
Bill?
80s, and it's not changed. So uh, I, I don't like that model. I don't want to feel captive, and I think most of my friends and colleagues that have gotten those promissory notes, they're kind of carving. It's almost like being in a prison sentence, and you're carving how many more months you have left to get out of jail. I don't like that. What we have done and looked at is making a true investment in a team, right? We're not giving you a note to keep you as a ransom patient here. We're making an investment in you. And you're right. We are very selective. You sent us a ton of leads and referrals. I believe last year we probably had north of 100 signed, LOIs, so to say, people that wanted to join. I think we only went with about 30 somewhat teams.
Mhm.
So we are selective. This is not an aggregation model. This is not, let's just roll up as many people as possible. No, it's a private partnership that we want to have a significant positive impact on, right? So we want to make an investment in people that truly feel, oh my God, if I had the access to what Summit's advisors have access to, a multifamily office, the technology, an in-house legal and financial planning team, in-house investment professionals and strategists, and risk management company and technology resources, marketing resources, all of that. Uh, I can only imagine what my business would look like, right? My practice would look like. And then while that investment is made, I'm leveraging and I'm growing my business. And most advisors are great at servicing clients and growing their business, but the industry has done a really poor job of creating an exit and an enterprise value for them.
Mhm.
Right? And that's not happened. So you look at the wires, yeah, you work your tail off and here, we'll pay you 2x to leave. I mean, that's insulting. I
Right.
mean, what advisor would tell their client, yeah, you've worked your whole life to build this business and practice, yeah, and sell it to your competition or sell it to whomever for 2x. That makes no sense. And it's not even 2x
Well,
as a capital gain. It's ordinary income. So
and it's
you may
also
as
a
well,
note for 10, 15, 10, 13 years. So you take a position in the company at an equity valuation. Again, let's talk about the ideal team, well diversified, fee-based, no FINRA, solid practitioners. Some of the valuations that are out there, is 4 to 6x plus minus, depending on the size of the team and the makeup of the team. But that's at a long-term capital gain. You take a 10 to 20% equity stake. Why would they sell any today? And I think you've already answered the question of, why invest? Why would you invest? Because you're going to make that investment grow. It also pays a dividend, but also what is the long-term outcome, particularly with the relationship merchant, if you can describe that.
sure, sure. So first question, why would you invest or why would you sell? Excuse me. Um, well, is a lot of questions. When we look at who would be the right partner, it would be somebody that truly wants to grow their business, wants access to better products, services, people, technology, all the things I mentioned, private investments,
Goldman
alternatives.
Sachs is a custodian that you use actively.
Yeah, we have five different custodians. So yeah, Goldman's absolutely one of our partners that we work very close with, and they've done a great job in not just custodial work, but a lot of their access points within the organization, right, to help advisors win business and whatnot. But we look at what's the growth path of that advisor and do they want to grow? We know the enterprise value already is there for Summit and obviously within the merchant ecosystem. But we're not looking for a guy to come in here and just say, I'm just waiting for the event and I'm going to cash out. That's not our model.
But,
Our model is to help you grow.
but what event is that? And if you can describe the relationship um, with merchant and why their enterprise mm, is, why is it working? Like, what's the relationship between merchant and Summit, and what is the long-term liquidity opportunity for these advisors who are aligned with you?
Yeah, so two things. Number one, most advisors, including myself, don't care about liquidity event if you can't grow to get there, right? That's not. Most of us look at the liquidity event as a bonus. Excuse me. And between now and some liquidity event, there has to be growth involved. There has to be value add, and that's what we focus on. So we help the teams get to a point where, most of our teams are $3 to $5 million of revenue and they're fee based and they continue to grow and continue to glide path going forward. But on the merchant side, obviously, if you're bringing multiple summit firms around the world together and they're working in a ecosystem that's collaborative, right? The earning power of that, the brain opportunity of those teams getting together, strategizing, that's worth a lot more as a monetization value than Summit doing it by itself or you and I doing it by ourselves. And look, you've seen the numbers that have taken place, multiple firms in the last, call it 3 years. Most recently with the SEI deal, right? You're seeing high teens in the 20s on multiples, and there's no way, I don't care if you have a $20 million team, okay, there's no way a team that kind of size can get that kind of multiple. So by leveraging the mothership, leveraging merchant's balance sheet, leveraging merchant's partnership, and leveraging the resources that we have internally, it's just a value add to short-term gains, short-term growth, and when there is an event opportunity that the advisors that are part of Summit and within the merchant ecosystem have a chance to participate and truly enhance and optimize their enterprise value.
So as I understand, Merchant has maybe 115 or so investments in uh, lots of RIAs all around the country. You're one of the stars of Merchant's portfolio. They're generating a lot of cash flow. It's run by Mark Spilker, who, of course, brought Apollo public as well as, Goldman Sachs. Um, so if you talk a little bit about them, again, that'd be great, of why that alignment, not only with Summit, but also how they might be able to participate in the relationship with Merchant.
Yeah, Mark Spilker, Scott Prince, Tim Bello, they are the primary leaders of merchant, and I'm not going to get into the whole merchant ecosystem and story. They're my friends, they're my partners. I have nothing but respect and admiration for what they've built. And look, as a private investor, I look back, you know, that firm's been around for what, 7 years? It is one of the largest privately held wealth management companies in the world. And you mentioned U.S. Merchant is well beyond the U.S. I think there are 8 countries right now. It is a powerhouse of dynamite leadership. Um, there's an alignment in every meeting and partnership structure I have with the guys. There's alignment. I mean, everybody's thinking about how do we help each other? What's the right way to grow? How do you service clients in a better way? It's just so unique from where I came from, right? It's a value add. It truly is a value add, and it's why the results are what they are. I mean, they just captured so much market share across the globe, especially here in the US, and the model works.
So as Merchant grows, as Summit grows, as the advisor grows, all in line with building the best possible wealth management advisory firm, uh, enterprise for Summit, enterprise for merchants. Advisors are able to benefit by the whole family to yield long-term equity results by potentially selling more equity in merchant in the future. Is that how it might work?
There's multiple ways of how a monetization event can happen, right? So the way I would look at it is every firm under the merchant umbrella is leveraging the power of merchant in various ways, capital, access to products, services, connections, all of that. Just like Summit is. Summit happens to be one of its larger hubs that truly has a broader infrastructure. So maybe we have over 200 employees within a Summit ecosystem. It's a larger firm. But the way all this would come down most likely would be every one of these firms will continue to grow. At some point, Merchant will announce that there will be some kind of monetization opportunity, and each one of these firms has an opportunity to bolt on and be part of that. And it could be various ways. It could be public markets, it could be strategic investor. There's no end in sight because the model that you look at here is very unique, right? It's a model that's growing. It's a model that's adding value. It's a model where you have full alignment. This is not a command and control. Every one of our partners around the globe is an entrepreneur. They own their business. They own their practice. Um, they are utilizing the services that they need to service their clients, and that's unique. That's not what I had at the big banks.
So there's a window of opportunity that there's just a mass, exodus out of these big banks. There's a lot of choices, but there's a window of opportunity here. And in my personal opinion, it's the next few years is one of the biggest opportunities advisors ever seen in their lifetime.
Hmm.
What would you like to say and pass on to your audience regarding the opportunity at Summit, the alignment with Merchant, um, and what would that be?
Well, look, I want to be crystal clear on one message. There has been an industry trend of people going independent, right? Leaving the big bulge bracket banks and firms. Some of those firms have kept their old models. Some of the firms have brought in new leadership and transformed the firms. I mean, look at a firm like Wells Fargo and the leadership team that's there and some of the changes they put in place. It's been pretty impressive. Great turnaround. Barry Summers has done an amazing job there. Kudos to him and his team, right? So I have a lot of admiration and respect for what they built. They also have a great ecosystem and organization around that. And it's truly up to the advisor of what do you want to do and what do you need from your firm. Going independent, it doesn't mean you have to be on your own. It doesn't mean you have to do it all yourself. And I think there are different firms and different opportunities for people based upon their needs. But when I look at Summit, we wanted to provide the teams and partners full independence, but not being left alone, right? Give them the resources, give them the skill set, and give them the opportunity to be able to run a practice versus having to run a darn business, which is that's a pain in the butt. There's a lot of work involved in running a business. And that's why I think you have such high, marks from our people. They have all the resources and capital they need to service their clients, and they don't have to do all the work behind the scenes to manage those divisions. They just have to work on their book of clients and meeting their needs and servicing them. And that's where Summit's really, stepped it up in a different approach and different model.
And Stan, you're humble, um, professional, but I have to say that this is, in my opinion, one of, if not the most exciting story that advisors need to learn about at Summit. Not
Thank
only
you.
is the model that you built for advisors, the costs associated with doing business, how you support them, how you have them grow, the alignment with the equity investment that you're making, how fast your firm is growing. I mean, it's growing like gangbusters.
Thank you.
Why, right? And why advisors? love your platform and the opportunity with Merchant. It's an opportunity, in my personal opinion, that begs a lot of um, you know interest amongst advisors. With that said, Stan, I really appreciate the opportunity to have you on, and
Thank you.
I'm looking forward to doing more business and seeing you again.
Thank you. Thank you. Thank you for the interest and have a great summer as well. Thank you.
Absolutely.